Hey there, and welcome to Real Estate Unpacked. So here's a question. When someone asks you what's happening in the real estate market right now, do you have an answer? Like a real one? Not the vague, it's a great time to buy, or inventory is tight stuff. I mean the kind of answer that makes people lean in and go, wait, how do you know all this? That is what this podcast is about. Every week, we are going to unpack what is actually moving the real estate market, the trends, the data, the economic shifts that matter. It's the stuff worth knowing, because here's the reality. Staying on top of the market shouldn't require a second full-time job, but your clients expect you to know what's going on. Whether you're a real estate agent who wants to be the go-to advisor in your market, or you're just trying to figure out if now's the time to make a move, this show is your weekly briefing on what matters right now in real estate and why. No economics degree needed to make sense of what's going on. Just straight talk about the market so you can be the smart one in the room when anyone asks the question. So let's unpack it. You know how sometimes you read the news and the economy looks like it's just humming along. Inflation easing here, consumer spending there, data flashing, steady growth. And you think maybe housing will finally catch a break. Maybe 2026 will be the year. But then you peek at the home sales numbers. Flat, stuck, barely moving. And you ask yourself, wait, how can the economy look good and the housing market still feel frozen? Well, friends, that is because, as many economists now put it, we are living in two economies at once. This week, I took a fresh batch of housing market forecasts, recent investor purchase data, inventory reports, and buyer sentiment signals from major players like Realtor.com, Redfin, Zillow, and some others. And what emerges is a picture that's, well, less dramatic than you might expect. Instead of a roaring rebound, 2026 looks more like a slow and steady pace, with modest gains in some areas, continued softness in others, and a market that remains meh. Yeah, I'm going with meh as an official descriptor. It's my own economic term I'm coining here, so go with me on this a little. And the meh market quite perfectly matches our split economy story. Strong signals on paper, but weak follow through in housing. So that nothing is really moving at all. It's just kind of unremarkable. So let's start with Realtor.com's 2026 National Housing Forecast. That forecast sets the baseline for 2026 nationally. Slower and steady wins the day. According to Realtor.com's new outlook, the housing market next year is expected to remain in what they call balanced territory. Supply is projected to average around 4.6 months of inventory across 2026. Now, mortgage rates, well, they're forecasting those to stay about where they are now. So a 30-year fixed rate will hover near 6.3%. And that is down slightly from the 6.6% average we saw throughout most of 2025. That dip, alongside expected income growth, helps reduce the share of a typical mortgage payment relative to median income, about 29.3%. Now that puts us as the first year back under 30% of the affordability threshold since 2022. At the same time, Realtor.com anticipates only a modest uptick in existing home sales, roughly a 1.7% increase, bringing the annual volume to about 4.13 million homes. That's up slightly from 2025, but still not far above the trough we've seen, and it's among the lowest volumes in decades. Now, the takeaway as a realtor, the national narrative for 2026 is one of stabilization, not a boom. For brokers and agents, this means advising clients, especially buyers, to view the next year as a fair weather window, with the possibility of some modest improvement in affordability, but nothing dramatic. Sellers should temper their expectations about rapid pandemic-style surges or bidding wars. And I actually want to go back to that line about modest improvements in affordability. When we talk about affordability, we are not talking about lower prices. We're talking about the fact that rates holding steady around that 6.3% coupled with expected income growth, well, that will make the house they're eyeing more affordable. So we should educate our buyers that when they're seeing the headlines about affordability, it doesn't mean prices are dropping. In fact, while affordability is projected to improve, prices, well, those are projected to grow about 2.2% next year, according to Realtor.com. So your client-facing talking points could be that you could mention to buyers that mortgage payments as a share of income are expected to drop below 30% next year, which is the first time we've seen this in several years. And this improves affordability for many households. For sellers, the hot take is that we don't expect a flood of buyers, but inventory growth and stable rates may finally give you a realistic shot at a sale without ferocious competition that we've seen the last few years. The next report I want to talk about is Redfin's report on investor home purchases for Q3 2025. This report shows that investors continue to play a relatively modest role in the overall market. In Q3 of 25, investors purchased about 17% of all U.S. homes sold, up only slightly from 16% a year earlier. That suggests investor demand remains largely flat, in line with a generally stagnant housing market. Moreover, profitability for investors is softening. A growing share of homes sold by investors returned a loss, about 8% in Q3 of 25, and that's up from 6.5% in the prior year. And that's the highest loss rate in more than 2 years. The takeaway for realtors: investors are no longer the cushion they once were for demand. If you're counting on investor activity to keep volume up, especially in markets with lots of rentals, flips, or investment-driven purchases, expect softness to continue. And your client-facing talking points could be that you could tell sellers that the investor segment is weaker and returns are thinner, meaning owner-occupants rather than investors are more likely to drive demand. That could slightly shift bargaining power toward the motivated long-term buyers. For investors themselves, given rising loss rates on resale, now may be a time to be cautious. The math on flips or rentals is less forgiving. If they're looking for a short-term commitment of just a couple of years, it might be wise to rethink that strategy. However, if the investor can hold steady for more than a few years and go in with the understanding that we could still have another rocky year or two, the future upswing could be very promising. I would ask that investor this following question. Knowing what you know today, if you could have bought an investment property 19 years ago, would you have? And I'll pause, fellow realtor, to ask you the same question. Do you wish you would have bought an investment property at that time, 19 years ago? Or 5 investment properties for that matter? If your answer is yes, well, do you know that if you would have bought 19 years ago in Q1 of 2007, you would have bought at the height of the market, when the median sales price was at a record high? This is the nature of real estate. We don't know what will happen tomorrow or next week or even next year. But if we can invest and hold, that model consistently works out. The same holds true for the stock market. And that could be a perspective shift your investor client could use right now. Okay, there was another Redfin report to come out last week, and that was a look at data for starter home sales from October of this year. This article spotlights what's happening at the lower end of the market. In October of 25, sales of starter homes, which are defined roughly as lower-priced entry-level homes, rose 4.9% year over year. And that marks the 14th consecutive month of growth in the starter home tier. Yet, even with rising sales, prices for starting homes only increased about 2% year over year, bringing the median to around $260,000. That modest price growth suggests affordability pressure is not intensifying for first-time or budget-conscious buyers, helped by a 13% jump in active listings of starter homes. And that has pushed inventory to the highest October level since 2016. So the takeaway here for realtors is that the entry-level market remains the most active segment. For agents, that means opportunities are with first-time home buyers and lower-budget households, and they may finally be able to find something in reach, especially with increased supply and modest price appreciation. Your client-facing talking points for buyers, mostly first-time buyers, a good line could be that starter home inventory is the highest it's been in years, and price growth is mild. If you've been on the fence, you may find real attainable options right now. And for sellers of starter homes, you can tell them that because of higher inventory, you may need to be patient and price realistically. But demand remains solid among price-sensitive buyers. And I've got one more report from Redfin because last week they were very busy releasing reports. And this one I want to talk about is their update that shows that while inventory is still rising, the growth rate is decelerating, and that's affecting buyer enthusiasm. At the same time, economic uncertainty is tempering market momentum. Many prospective buyers appear to be holding off on major decisions. And if you've been selling real estate at all this year, you have felt that pause. And that hesitancy is contributing to sluggish transactions, even as supply continues to work its way off the sidelines. The takeaway for realtors on this article is this is a classic soft rebound. Inventory is up, but buyer demand is cautious. For agents, it means marketing matters more than ever, and homes may sit longer on the market, and negotiating power may begin to shift slowly towards buyers if it hasn't already in your market. The client-facing talking point for buyers is that while payments are a bit lower than a year ago, many buyers are pausing because they just don't feel confident about where the economy or rates are going. But if you find the right home and lock in a rate, you may have more leverage in negotiations. And for sellers, the talking point is that you're not looking at a race to the finish line. Pricing and patience will matter. In some areas, you could face buyers who are willing to walk away if the terms don't meet their budget. And I think this is actually the perfect place to pivot to this concept I'm seeing play out in the market right now. We're probably all aware by now that consumer sentiment is down. People do not feel good about the economy. Surveys show anxiety about inflation, job security, interest rates, the whole thing. The economic vibes, well, they are grim. And yet at the same time, we keep getting pretty strong CPI and consumer spending data. Inflation is cooling in some categories, retail spending is holding up, and GDP keeps refusing to roll over. So how can both of these things be true at the same time? How can people feel bad about the economy but still be spending like the economy is fine? Well, the answer to that is that we are not living in one economy right now. Nope, we are living in two economies at the same time. And economists call this a bifurcated economy or a K-shaped economy. One arm of the K points up and the other points down. At the top of the K are higher income households. These are people who own assets, homes that appreciated rapidly, stock portfolios that have surged, businesses that benefited from post-pandemic demand. And this group is spending aggressively, really aggressively. Recent data shows that the top 20% of earners now account for more than half of all credit card spending in the US. And what's even more striking is that their spending, adjusted for inflation, is up 86% compared to 10 years ago. Meanwhile, the bottom portion of the income distribution is spending more too, but only about 50% more over the same time period. The gap is enormous. So when we look at strong consumer spending and relatively solid CPI trends, what we're really seeing is that the wealthy are propping up the economy through consumption, like travel, dining, luxury goods, experiences, services. This is where the money is flowing. But here's where things get interesting. That surge in spending, well, it has not translated into a meaningful recovery in the housing market. And at first glance, that seems contradictory. If the people with the most money are spending at record levels, shouldn't they also be driving a major rebound in home sales? You would think so, but the housing data tells a very different story. Nationally, we sold about 4.09 million existing homes in 2023, about 4.06 million in 2024, and right now, we're trending to hit around 4.1 million for 2025. Realtor.com's forecast for 26, well, they're estimating that we'll sell about 4.13 million homes in 2026. That means we are essentially stuck around 4 million home sales per year for 4 straight years. That is one of the slowest stretches of housing activity in nearly 3 decades. So how do we reconcile these two realities? Here's the key distinction. Spending on consumer goods is not the same as committing to a home purchase. Buying luxury goods, traveling more, upgrading lifestyle experiences, those are short cycle decisions. You swipe the card, you get the reward, you move on. Buying a house is a long cycle, highly leveraged, emotionally loaded decision. It requires a stable outlook on income. It requires confidence and long-term affordability, willingness to take on debt, and belief that your financial future is predictable enough to anchor yourself to one asset for 5, 10, maybe even 30 years. And this is where the bifurcated economy really shows its teeth. Yes, the top 20% can't afford to spend more. And yeah, they're driving GDP growth. And yeah, they are largely insulated from food inflation, airfare prices, and restaurant tabs. But that same group is not large enough to single-handedly normalize housing volume. Because housing is not powered just by buyers. It's powered by move-up chains. One sale enables the next and the next and the next. And most of those chains run straight through the middle and lower middle class, the bottom 80%. And right now, that 80% is being crushed by high shelter costs, insurance inflation, auto costs, student loans, higher interest rates. They aren't out there buying European vacations. They're trying to keep their monthly budget intact. And when that group pulls back, housing volume stalls, even if the wealthy keep spending freely. This is why we can have strong consumer spending, decent CPI trends, and a resilient-looking economy, and still have one of the weakest housing markets in decades by transaction volume. Now let's bring in a metaphor that really ties this together. Economists have described today's economy as a top-heavy Jenga tower. All the visible strength, the spending, the stock market gains, the GDP growth, well, all of that is coming from the very top blocks of the tower. Those blocks are holding everything up, for now. But the base of the tower, the broad middle class that traditionally supports housing, household formation, and long-term economic momentum, well, that base is wobbling. And that makes the system look strong, but structurally fragile. Because in a normal economy, spending is diversified. If one group slows down, another picks up some of the slack. In today's economy, so much of the momentum is concentrated in such a small group that any meaningful shock at the top, whether it's a stock market correction, corporate earnings slowdown, or a financial market disruption, well, that can have an outsized effect on everything below it. If those top blocks shift, even a little, the whole tower becomes unstable. And that is the risk we need to be watching closely, especially in real estate. Right now, the housing market is not being held back simply because mortgage rates are high. Rates matter, but that is not the whole story. What's really holding housing back is that the majority of households don't feel financially secure enough to transact, even if the wealthiest households feel comfortable enough to keep spending. So when people ask, when will buyers come back? When will rates fall? The more important question may be, when will the bottom 80% of households feel stable enough to participate again? And until that happens, we may continue to live in this strange economic world where the economy looks strong, consumer spending looks healthy, but home sales remain stuck in low gear. A strong economy on paper, a fragile foundation underneath, and a Jenga tower that works right up until it doesn't. So how are the experts planning on this playing out in 2026? Well, Zillow released their 2026 housing market predictions last week, and Zillow adds a more bullish but still modest voice to the mix. They expect the market to warm up in 26 with more sales and modest price growth. And that said, Zillow, like others, well, they don't predict a dramatic resurgence. Their forecast also suggests inventory increases and mortgage rates hovering slightly above 6% and a slow but perceptible shift towards balance. So the takeaway on this article for realtors is that Zillow's outlook offers some hope, but it's tempered, and use that as a basis for setting tempered expectations with clients. Stable market, gradual movement, but nothing flashy. And the client-facing talking points are that for buyers, Zillow expects modest price growth and more homes coming on the market next year, meaning you might get more options without a steep escalation in prices. And for sellers, don't expect a dramatic bidding war. It's kind of the same thing we've been saying for a while. But if you price well and prepare properly, you should still see interest from serious buyers. All right, so we have talked about reports from Realtor.com, Zillow, and Redfin. And one of the most interesting things across all these articles is how slightly different each forecast is. Yet they all point to the same broad thesis. 2026 will be a normalization, not a boom. Realtor.com, Zillow, Redfin, and others all expect only modest gains in sales and prices, with inventory gradually climbing and affordability inching up. That said, there are important differences. For instance, Realtor.com emphasizes a return below the 30% affordability thresholds in terms of that payment to income, while Zillow paints a more cautious, balanced but slow picture. And Redfin underscores buyer caution, even as supply rises. And across investor data, there's no significant rebound, which undermines the potential upside many had hoped for if investors returned en masse. For realtors, the takeaway is that the next 12, maybe even 18 months are likely to reward patience, strategic pricing, and educating clients rather than promoting hype or aggressive predictions. Local market conditions will matter more than national headlines. And there you have it. A week where every major housing report is technically saying something different, yet somehow they're all humming the same tune. A tune that sounds a lot like quiet normalization. Rates edging down but not diving. Prices rising but only politely. Inventory growing but taking breaks whenever it gets tired. And buyers and sellers peeking around corners, still deciding whether they trust the economy enough to make a move. What the data keeps reminding us is that housing is living inside a bifurcated economy. The top end is still spending, the bottom end still stretching, and the middle just trying to figure out which direction the floor is tilting. Until more households feel genuinely stable, transaction volume will stay in this slow, deliberate rhythm. Not frozen, not thriving, just steady. And for real estate professionals, this moment is less about predicting the future and more about translating it, helping buyers recognize opportunity when affordability improves around the margins, guiding sellers towards realistic expectations in a market that rewards patience and preparation, and grounding both sides in the idea that clarity beats urgency, because this is a market that moves with confidence, not adrenaline. So as you head into the week, think of the economy like that top-heavy Jenga tower we talked about earlier. The upper blocks are holding things up for now, but the health of the whole structure depends on the base regaining its balance. Housing will follow when that balance returns. Until then, your role is the same as always. cut through the noise, steady the nerves, and help people make decisions they won't regret when the tower finally settles. And we'll be right back here next week to help you keep sorting through these signals, one calm conversation at a time. I'm Jennifer Templeton. I'm a fellow realtor and a broker associate with the Crestage Group at Keller Williams Rockwall out of the Dallas-Fort Worth area. I hope you found this helpful. Thanks for listening, and I'll see you next week.